You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it's time once again for Volatility Views, the premier program for volatility traders. And my name is Mark Longo, coming to you from the Options Insider Radio Network studios here in, I wouldn't say scenic and sunny. There is a sun out, but I wouldn't say it's particularly warm and tropical this time of year here in the options mecca of the world, Chicago, Illinois. That said, we've seen worse January, so nothing to complain about here. And of course, from here in the nice warm inside of the studios, we produce a wide array of options content for your reading and indeed your listening pleasure. That can include, of course, over there on the website, all of our written content, as well as our email newsletters. If you don't sign up for those, I don't mention those a lot here on the show. I probably should mention them more. Once a week, we put out a retail-oriented newsletter every week. We also are adding more newsletters to that mix every week. Goes out to about 40,000 subscribers every week. So you're interested in learning more about all the different stuff we talk about in those newsletters every week, a little bit of vol, a little bit of analysis, unusual activity, all the other fun stuff. Sign up for that. Stay tuned for more. You can find that, of course, on the website or going to any of our Twitter outlets, etc. And of course, while you're there, click on that Insider Radio Network tab. That'll, of course, take you to all of your favorite shows, including all the archived episodes of Volatility Views. There's quite a few of them in there for you to choose from. So a lot for your listening and downloading and streaming pleasure. And of course, you can also get at us on all of the big platforms, iTunes, TuneIn, Stitcher, etc. More people are getting into the podcast fray every day. So when Google Play starts adding podcasts, don't worry, we'll be there too. In the meantime, we can, of course, get us on the Google Play App Store via our mobile app, as well as in the iOS and Amazon App Store. So the list of places you can find our compelling options content growing longer every day. So if we're not on a platform you're looking at or some obscure tool you like to use to get podcasts, let us know. We'll make sure we're there as well. And of course, while you're listening, while you're reading, while you're downloading, while you're streaming, send us your questions, your comments, your insights. We'd love to hear from you guys. All right, and joining me on the old program today, let's start off from the corner office and beam out. Joining us from the exclusive, the exotic corner office over there at the Options Institute, he is Mr. Russell Rhodes, a senior instructor over there at the CBOE Options Institute. Mr. Russell Rhodes, welcome back to the program, sir, and how are things in the palatial corner estate?
It's got its own ecosystem. That's how exotic it is. I left a half-drunk cup of coffee over on the corner of the palatial office, and something weird's growing out of it. So that's how exotic things are over here.
You have microclimates. It's so large. You have this zone is about 55 degrees and temperate. This zone about 75 to 80, more tropical for your humid needs. You have the microzones within the palatial estate. I understand that. Someday I hope to have an office of equal stature to yours, sir. In the meantime, we'll turn our attention to a man who's known a few offices in his day. He is the hermit crab of the volatility space. He jumps from office to office. Sometimes he's downtown, sometimes he's in the hinterlands. Today he's beaming to us from the downtown office of good old Option Pit, as well as Carmen Line, as well as the boys over there at Typhon. Kind of a mixed bunch over there. Mr. Greasy Meatball himself, Mark Sebastian. Mr. Greasy Meatball, welcome back to the Volatility Views program, sir.
Good to be here. Great to be here. Lovely to be here. Looking at all this volatility trading, I'm excited to chat it up today.
Yeah, a lot to chat about. So without further ado, let's get going. Time for the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. Like the man said, this is indeed the portion of the show where we break down what is rocking and rolling, what was catching our eye in the week that was from a volatility perspective. And as Mark said, it was indeed yet another interesting week from a volatility perspective. This month, this start to the year has been essentially no shortage of interesting things to analyze and talk about and discuss from the realm of volatility. So selfishly, from our perspective, it's been a great month. Maybe for some of you out there, better than others. But yeah, January coming to a close. We are recording this here on the final trading day of January, and what a month it's been. Pretty much the most tumultuous January on record here in the markets. We had a bit of a rally in the last few sessions, so I'll have to check in and see what stead that puts us in. We were on track for the worst January in the history of course, in modern markets. These last few sessions of rally may have tempered that somewhat. We are recording this today, of course, like we said, Friday the 29th. Most of the major indices up and up heavily on the day. S&P up about 1.7% right now. Dow up about 1.8%, and the Qs up about 1.6%. All of that on the news that our friends over there in Japan deciding, hey, we're going to go negative on our rates. We joked about negative rates here on the past in the show. Folks in Japan deciding, yeah, we're going to go that way, trying to bolster their markets, as well as a decent slate of earnings last night from some, not all players. We'll get to that in a little bit as well. And of course, with all this green on the screen, VIX taking a bit of a breather today. VIX cash hovering still in that 20 handle, but ever so slightly, ever so briefly flirting with breaking through that 20 handle. VIX cash hovering right around 2018 or so as we are recording right now. We'll see if we can even dip through that 20 handle by the end of the show. But while we're waiting for that to happen, let's turn our attention to these here markets. We'll start with you, Senior Greasy Meatball. What caught your eye in the week that was from a volatility perspective?
For how much we've rallied and how how much we've crept higher, vol futures are staying stubbornly backward. And while February is trading at a nice premium to VIX, February is also trading at a nice premium to March. You've got almost the entire curve now trading above the VIX cash, and quite quizzically, we're up about $30 right now going into a weekend, and VIX is only down $2. As I kind of smell the market, even with the SPOOs up 1.5% and the Russell 1000 up almost 2% and the Russell 2000 up over 2%, the lack of active volatility selling makes one wonder whether the market fully believes what it's currently viewing right now, and whether this is an opportunity to maybe cover some short vol and step in and buy, or leave on some long vol. That's kind of what I look at and wonder. And and the approach I would take to trading in this market as I view it right now, which is at, about 12:15 on Friday.
You're right, because at first blush, someone just glancing at these numbers, seeing a rally, seeing a VIX coming off, may assume, vol is coming down. And yeah, as we said on the show many times, it's kind of the way the product is structured, not so much what's going on behind the scenes. And you're right, a day like today, you expect things to take maybe a bit more aggressive of a drubbing, certainly in the futures, yet you're right, they still are bid in that near term, and the product still remaining enough resiliency out there from a volatility perspective to indicate that, perhaps sensibly so, people are reluctant to just whack away at bids going into a weekend, given just how much evidence we've seen just in this past month alone, that crazy things can happen at pretty much any time, certainly over the weekend. We have this will they, won't they dance with Russia and OPEC regarding oil, and of course Japan today, and the Fed lingering very recently in the rearview mirror. We have all these other systemic shocks lurking from China at any given moment. If you're racing to go out there and just crush some bids and vol right now, maybe you haven't been paying attention to the game we've been playing over the past month. But that said, let's turn our attention back to the microclimates of the corner office. Mr. Rhodes, what's been catching your eye in the week that was, sir?
Well, not necessarily the week that was or the week that's wrapping up, but I think I got a reason that we're still at elevated levels, and it's because we've got an employment number next week. And if you go back and you look at what the front month future has done relative to VIX, and not thinking about the weeklies, and then you look at what happens after the employment number comes out, there's usually a crunching of the spread, I guess. But the future tends to move a little bit to the downside relative to the index, regardless of what happens with the employment number. So I think that's one of the reasons that we remain in backwardation when you're looking at the front month versus the second month. I think it's very dependent on what happens with the employment number and how the market reacts to it next week as to whether we stay in backwardation or not.
That is the question of the day. It seems like everyone kind of waiting and wondering when will that near term of the curve finally relax a little bit. Ain't happening yet, listeners, but the show is still young. You never know. It could unfold even as we are recording. That would be a pretty drastic move, but you never know. I think crazier things have happened. We talked last time we were together, and we've talked frequently on this program over the many years of its history about, where that breaking point is from a volatility perspective there in the marketplace. Where in the VIX spectrum do you think things go from good to bad from a volatility perspective? Or a little bit of vol is a good thing, but too much of a good thing, it could be dangerous in terms of people deciding, yeah, this is too rich for my blood, too volatile for me, I'm taking my ball and going home. We were talking about this a little bit last week on the show, and I think we were all kind of flirting around that 30 or so handle. Once you start getting beyond there in the VIX cash, it indicates things may be getting a little bit dangerous out there. Certainly at that 40 handle, definitely, I think everyone can concur that is the breaking point. But that number tends to vacillate a little bit by people's individual risk tolerance, it seems, a little bit as well. It's kind of a good barometer when you ask someone that question, where exactly they fall on the spectrum. Well, Goldman came out with their number earlier this week. They use a different term for it. They call it the VIX red zone, and they call that where essentially when it's at that level, that's where essentially they feel that there's risk of recession and a lot of other damaging things for the economy. And good news, listeners, we're out of the red zone. According to the Goldman research here, they term the red zone as being a VIX above the 25 handle. So they're even a little bit slightly more cautious, I think, than a lot of people who probably push it at 30 or maybe 32 or above, saying once VIX is at 25 and rising, they term it, that historically coincides with flat or negative U.S. GDP and a lot of other measures that could really indicate a potential recession on the rise. So there you go, Russell and Mark. You guys can stop worrying now because we are indeed out of the red zone. All concerns have been met.
Yeah, I don't know about that. Take a look at the way bonds are blowing up. Take a look at the way again, yeah, we've got non-farms, but going into a weekend, I would expect this to come in Monday with VIX around here with the move that we've had. But it's kind of nutty the way this thing is running around and moving, and how stubborn vol futures are. Super stubborn. And so, And oil is now down on the day. It looks like that deal that the market partially rallied on might fall apart. I think the most quizzical piece of all that I just mentioned is bond vol. We've had bonds moving around long term. The 10-year, and the 30-year have been flying around, and TY VIX is currently 5.6%, up 20 cents. Not exactly a ginormous move in Treasury vol, and it's really failed to see any true volatility materialize in those options. And if you look at OIV, that's off today. So it's kind of interesting seeing all the different pieces of the way of the market, kind of how they're interacting with each other. So I wonder exactly how all these pieces fit together. You've got oil vol in the 60s. You've got S&P vol stubbornly above 20, and then you've got bond vol that doesn't even want to move. So I'm not exactly sure how to approach this and really where the market is pulling these different pieces from.
Somehow I had a feeling you would not subscribe to that belief that we're out of the woods just yet. Speaking of TY VIX, I'd love to talk about it more on the show. I think selfishly, Russell, you need to put it through to the research team. You guys come out with a really great report every week, and it comes out right after we finish recording the show every week. So just selfishly, from our own recording perspective, if they put out that data like an hour or two earlier, it'd be so much easier to use that on the show. So mention that at your next little corporate meeting there. But aside from our internal politics, Russell, speaking of which, you kind of tweeted about something interesting earlier this week that caught our eye and some of our listeners as well. You were tweeting, as you are wont to do, about the vagaries of different VIX ETPs, including one of our favorites here on the program. We love to discuss and or mock in equal measure, VXX. You tweeted out an interesting chart, or a table actually, showing essentially the performance of VXX versus VIX, particularly when it comes down to the first and second month backwardation in those products. Why don't you break it down a little bit for our listeners who may have missed your tweet and what you were actually getting at with that?
Well, what I tweeted out was just the annual returns for VXX, and actually the annual return going back to 2006, because we do have index data. VXX was launched in in 2009, but we do have index data that gives us an idea of pretty much what VXX would have done starting at the beginning of 2006. It would have been down 50% the first month, or that first year in 2006. But in 2007 and 2008, it actually would have had some pretty stellar years if the fund had been out at that time. And in one of the reasons they would have had a pretty stellar year is because in 2007, the front month future was at a premium to the second month future about 1 in every 5 days. And in 2008, of course, a lot of this was back-end weighted with the financial crisis in 2008. About 35% of trading days saw the front month future at a premium to the second month future. As far as 2016 goes, every day this year, the first month VIX, whether it be January or now February, has been at a premium to the second month VIX. And that's one of the reasons VXX has held up as well as it has.
Yeah, a lot of interesting data. If you're not following good old Russell over there, check it out if you're interested in all the interesting minutiae and vagaries he digs up in the realm of VIX and VXX and related products. So just follow us. We like to retweet some of that stuff too as well. And Mark's been known to tweet an interesting pearl about VIX every now and then as well. So if you're not following all of them on Twitter, you should do so to get your volatility fix.
Well, just one other thing with respect to the table that I put up with VXX. Sometime this weekend on my list of things to do, I've gotten a lot of requests to put together what TVIX or SVXY or UVXY or XIV would have done from 2006 on. We know they're not exactly 2 times the VXX, and the inverse relationship is not exactly opposite as well. So I'm going to expand on those numbers that I tweeted out yesterday.
There you go, listeners. And now it's time for my favorite part of the show, and I know probably Mark's and maybe even Russell's as well. That is, of course, Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
I do love that transition. I can listen to it all day, sir. But Russell, what caught your eye in this week's weekly VIX Options Palooza?
You know, Russell, I need my own opening I need my own segment so I can have an opening as awesome as yours.
You come up with the greasy meatball segment. We'll put something together for you, too.
Mark's meatball vols. Meatballs.
That was the favorite that I had of all the choices I was given. All right, here I go. Everybody behave. All right. So, I've been taking a look at the February 3rd weeklies, and there's the biggest open interest for both February 3rd and February 10th is a spread I talked about before, where it looks like somebody sold the February 3rd put, 16 strike puts, and bought 13,000 of the February 10th 16 strike puts, and that trade's still open. We typically have somewhere between 50 and 100,000 open positions going into the weekend with the following week's weeklies, and we've got about 70,000 open with the February 3rd contracts. It's pretty balanced between the calls and the puts right now. But as I mentioned just a few minutes ago, next week is an employment week, and that's what I was really looking forward to when we launched the weeklies with VIX, was how would the weekly futures and how would the weekly options act around what is basically an earnings announcement for the economy. And it's kind of interesting. We don't have a whole ton of open interest quite yet with the February 10th. So I'll be keeping an eye on maybe some positions to get put on earlier mid next week with the February 10th options. Right now, it looks like it's a little bit more skewed to the call side with some open interest at the February 25s and the February 10th 25 calls and the February 10th 18 calls as well. And there's actually open positions all the way up to the February 10th 40 strike calls. So, and I know some of that was some buying. So somebody's rooting against the employment number. Maybe, you know what? Maybe the Japanese guys got hold of the employment number, and that's why they went ahead and cut rates for us.
There you go. Conspiracy talk. We love it.
Yeah, we always used to think that the Fed had all the numbers way in advance, and that's why they were doing what they were doing. So maybe the Japanese hacked in and got it somehow.
Yeah, well, there's a lot of that conspiracy talk this week when there was talk that the Fed number leaked early and all that other nonsense. We love a good conspiracy here. We haven't checked in with the folks at Zero Hedge in a while on vol views. Maybe we should do that to get our latest dose of tinfoil hat market extreme edition. But thank you for that, Russell. You're right. These are kind of interesting times for the weeklies in general, because on the surface, you'd say, wow, things are rocking and rolling. These should be ideal times for a product like that. A lot of intraday movement. These are great times to be in those. But on the flip side, not so much maybe this week, but particularly in the middle of the month into the latter weeks there, where we were really, really moving quite a bit, that it almost got a little bit maybe too scary, getting back into that red zone / breaking point conversation again, where maybe it'd be too much for these weeklies. You can just get whipsawed out too much. People would be not playing in them or maybe moving a little bit longer term. So interesting to see that the weeklies are still lighting it up, and going into the weekend sound like they're going pretty strong. And some interesting bets. We'll have to see if the Japanese are playing us all for fools here coming next week here, Russell. Thank you for that. Your weekly rundown going into the big mothership VIX options products this week. Saw a lot of interesting and diverse paper going up on the board today. The week kind of started off surprisingly maybe a little bit light with not a lot of paper, 200,000, 300,000 going up, 400,000, kind of climbing incrementally throughout the week until we get to about Thursday, when it started lighting it up, doing over the ADV there later, 650 or so going up. And so far today, it's still a decent paper, about 380, nearly 400,000 contracts going up. So today looks like it's going to be on par for another busy day out there as well. And we saw a few interesting, decent-sized trades out there during the week. Probably one of the weirder ones, and probably this one probably fell on your radar, Mark and Russell, as well, was just kind of like a couple of size trades going up yesterday on Thursday. Some on the similar strike, different times, so they could have been related, or they could have been just playing on the same strike at different intervals. Again, pretty sizable, so I'm guessing the latter, probably unlikely. Started off with a bit of a funky one, looked like a bit of a four-way out there in March, where we saw the March 25-27 vertical going up. Actually, not a vertical, looked like more of a stupid 55,000 times. Pretty much hitting lifting offers on both the 27s and the 25s out there in March. And then we saw the March 20 put probably another perhaps stupid there as well, going up there. Both of those prices a little bit more mixed, so they're kind of hard to intuit exactly what was going up there. So it could have been a bit of a funky risk reversal calls versus puts as well, but I don't have all the data on that one to parse where that went in. At the same time, we also saw a pretty sizable March vertical going up. I shouldn't say at the same time, about 45 minutes later, but same strikes, which kind of caught a lot of people's attention back in the March 27.35 vertical, going up. Paper buying the 27s, selling the 35s, doing that 80,000 times. So a lot of paper going up, including some very funky paper going up there on Thursday. I also saw a bit of a put 1x2 going up earlier in the week. It was the March 1922 put 1x2, 18,000 by 9,000 times, 18,000 on the 19s versus 9,000 on the 22s. So a lot of interesting stuff. Also saw going up later, we saw people lifting about 13,000 of the March 30 calls earlier this week as well, doing it for $1.25, getting back into that ever optimistic realm of course, given recent history, that isn't as optimistic as it may have yet appeared. I don't know, Mark or Russell, did this kind of funky four-way / vertical fall on your radar this week, and what do you guys make of this one?
I took a look at the 27.35 vertical. That was kind of interesting to me, and I actually threw it out there in a blog last night. In order for that one to pay off, that you've got to get You've got to get VIX up to 28, and it hasn't closed that high this year. Even though we've been at an elevated level of implied, VIX, intraday we've gotten up to 32, so they could be kind of nimble and profit from that one. But both those trades need us to see new highs and new 2016 highs in VIX to make money.
Yeah, if they're looking at just the near-term chart of VIX, they may see that spike up to 32. You're right, but that wasn't a close. That was just intraday. That day we actually closed at around 27.5. So you're right. You need a bit of a sustained upward movement for that. Either that or a big sharp pop, and they have to be savvy enough to get out while the getting is good. If they are that nimble, then that could be an interesting one. But you're right. That one first caught our eye, then it kind of led us to the rest of that other legs of that four-way that was unfolding that day. All of that kind of contributing for why Thursday was, so far at least, the volume leader out there from a VIX options perspective, with a lot of funky spreads going up, in that four-way, 55,000 on each leg. So talking 200,000 contracts there alone. Mark, any other activity catching your eye this week out there in VIX options land?
Yeah, there's definitely still a lot of interest in Feb. One trade that I thought was a little peculiar, a guy for 13 cents sold the Feb 1747 strangle, traded about 5,000 of them. There was also an 80,000 lot of the March 30 calls that traded in size, and the guy was a buyer. So there's still some pretty decent interest in a lot of what I'm seeing. Today we saw Feb 2024 strangle buyer pay $2. So there's still a lot of activity. The one that I scratch my head on is that strangle. Just not a huge believer that that's a brilliant move to be selling 13-cent strangles that can absolutely blow up on you if VIX vol even kind of pops a little bit. He or she is going to be in a world of hurt.
That is the proverbial picking up nickels in front of the steamroller on that trade. And a few of those, it may seem attractive at first, but one of two of those can certainly leave a mark. You're right. A lot of interesting, kind of obscure size paper going up this week, even though the week itself wasn't the heaviest volume week. Speaking of light volume, overall open interest still, as a result, not surprisingly, still a little light. Sub 5 million contracts outstanding, about 3.1 on the calls, about 1.7 or so on the puts. Looking at where all that activity is alighting this past week, the hot strike still number one, which is for pretty light volume for the top of this charts, is the Feb 30s. Again, that 30 strike still resonating with a lot of people. That goes back to one of our discussions we had earlier on this program about just how the even strikes still seem to resonate with people out there. It goes back to that psychology of the trader. Number two, March 27s, about 170,000 contracts open. Then we go back down to 160,000 of the March 35s. So again, ever more optimistic, maybe some of that relating to that vertical we just talked about a little bit earlier. And then, of course, the Feb 40s and the Feb 25s. So a bit of a discrepancy there in terms of strike, both around 140-odd thousand contracts open. And then the Feb 23s, a little bit more close to home, 121,000, down to 7 and 8 to find the first puts on the top 10, about 117 and 112,000 open respectively of the March 20 puts and the March 18 puts. Again, a lot of that feeding back into that funky four-way we were talking about earlier, and then a clear 107,000 open of the March 30s, and wrapping it up, some more puts with about 102,000 open of the Feb 20 puts. So again, pretty light stuff here from an overall volume perspective, despite the fact that things were actually happening this week. We talked about the macro stuff, but of course, let's just wipe all that away for a moment. Forget macro, forget Fed, forget all that other nonsense. Let's focus on some things we can actually sink our teeth into. In particular, earnings season. We're kind of in the thick of it right now, and we saw some big names popping off this week. In particular, we saw Amazon kind of leading the charge last night. They closed yesterday up 52 handles, I think it was. That straddle went up about $53, so they were expecting at the time about an 8.5% move, and what we saw was a massive crushing in the overnight market, down nearly 2x that, nearly 100 handles in the after hours. As we're trading today, Amazon off about 50-odd handles. So again, net pretty much just giving up what it made intraday yesterday, but still just extreme rocking and rolling out there in Amazon land. That comes on the heels of a lot of people reporting and us looking into the numbers as well, that just a lot of that paper going into Thursday's earnings was on the upside. So it was kind of reminiscent of the early days of Apple a few years ago, where people were just gobbling up that upside skew. We saw the 650s were lighting it up to the tune of 7,500 contracts going up, 640s, 4,200, 670s getting pretty optimistic there, 4,200 of those opening, 3,000 of the Jan 680s, and 5,000 of the 700s. These are all in the weeklies, listeners, the Jan weeklies going on. All of that's pretty much opening paper, 5,000 Jan 700 calls. Needless to say, the stock hovering around 585 right now. Those are not looking too pretty with a few days to go on there. But Amazon was clearly the rocking and rolling leader when it came to expecting and indeed delivering from a volatility perspective. Premium buyers, the order of the day out there, and certainly the winners, at least not from unless you were going pure directional like a lot of people were, in which case it seems like there might be some sad faces out there post Amazon earnings from an options perspective. Looking out here at EA as well, they also reported yesterday they were expecting about a 6.5% move out there, about a 450 straddle. That name trading in the mid 60 handle, opening in today off about 9% or about $63.50 here. So this one also another name where at least net volatility buying paying off for the traders. And then finally here, the name that catches a lot of people's eyes out here was, of course, good old Softy. This one, they were pricing in about a $3 straddle, so it worked out about 5.5% move or so. And what we're seeing here is pretty much precisely that move. It seemed like it was going to fade a little bit in the after hours. We had a decent pop, and then it kind of gave it back. Now today, on the heels of the strong rally in the broad market, lifting Microsoft again. So up about exactly $2.90, or right about where that straddle was pricing, right about 5.5%. So that one kind of coming in line. But Microsoft becoming more of an interesting player to watch in earnings season over the past year or so than it had been pretty much in the previous decade, where most people kind of just wrote it off as a lost decade for Microsoft, certainly from an options perspective, where it really didn't deliver much. Russell, I know you watch a lot of earnings. Anything catching your eye this week from an earnings vol perspective?
Well, not this week, but next week, we've still got one of the FANG stocks left to report, Google. And, it's whenever it's had a big move or a big pop over the last 3 years, it's been to the upside. So we'll see if they over anticipate that one or not. I don't ever recall Google not reporting on a Thursday.
Yeah, that one kind of surprised me too.
In fact, I had to triple check to make sure I had it correct on my calendar. But,
I thought they'd already. Why did I think they'd already reported?
Because there's about 15 different handles for Google now. It's confusing to keep track of them all. Google, Alphabet, etc.
Yeah. So the Google with an L is what I've got coming out Monday, and that one it's rallied as much as 16%, and the biggest drop has only been about 3.6%. So if you want to play the odds as far as history goes, maybe you look at something to the upside, and maybe you look at a bull call spread or something like that.
Pricing about a $50 straddle, Russell, and although it just moved $60. Or it just moved $40 in the last couple days off Facebook. What we're discovering is that Google and Facebook are both going to be worth more than Apple this time next year. I think that's kind of what we're discovering. And so, a trade that I was looking at is kind of interesting, and I've really started developing trades in this manner. Is I love, especially when I've got a directional opinion, and tell me what, feel free to criticize this. I love setting up kind of little butterflies where my long wing is kind of at the very edge of the earnings straddle, and then the other stuff is kind of that way out of the money junk that retail flow likes to buy from me. So that's a trade that I may set up here. I can currently, on that $50 straddle, I could set up like a 810, 830, 850 fly for about $3, and which is about a 10-to-1 payout. And the market is pricing if you go, but the straddle is going to be right about 58% of the time. And if you consider that it's 50-50 to go either way, it's a 24% chance that I'm going to, or a 21% chance that I'm going to get to at least 760, and I'm getting 10-to-1 odds. So it seems like that might, and as long as the thing doesn't completely overshoot me and move 2 standard deviations, that's where I'm going to get beat. But what do you think, Russell?
You lost me with all those moving parts, Mark. Sometimes you just move too quickly for me. So my fear would be actually, with what you were talking about, would actually be overshooting on the upside, even though we've gotten the price movements that we've already gotten. Yeah, I wonder if just because they're reporting after everybody else, and they're reporting after they've been able to adjust, or people have been able to adjust their expectations with some pretty good information, if that's gonna change the dynamics around trading Google or not.
Yeah, I mean, I can buy it for about $1. I can buy it for about $1.50, and it's not a bad little. I might bid that out there just to see what I can do. The other thing that's worked out, I don't like trading time spreads. I don't like carrying time spreads into earnings, but they can be a wonderful trade around earnings. So buying the time spread on a day like today, and then we're looking to sell it before earnings are even announced on Monday. That can be a nice spread sometimes.
No, absolutely.
That goes back to the old get some free days of juice before you have to ride, and then get out before you have to ride the turbulent, choppy waters of the actual event itself. But, all this talk about Apple, not even Apple, but Amazon and Google and all these other high-flying names, it just makes me sad yet again that the minis were such a pronounced failure, because this would be an ideal time to have minis listed on the Googles and the Amazons and whatnot, because so many, particularly on the retail side, are now kind of left kind of twiddling their thumbs while these $700 names are out there reporting and beyond, in some cases, reporting earnings, and maybe they can do a one-lot spread here or there, something like that. But nothing really consequential for them. The minis, that would have been a nice way for people to at least get their foot in the door a little bit more, maybe do a little bit more than that, and be able to participate in a lot of these things, because right now they're kind of off limits for a lot of the people on the retail side of the spectrum, which is an unfortunate thing. And yet again, the mystery of why the minis were allowed to die is one we'll talk about a lot here, I'm sure, in the future. Meanwhile, let's move on to away from earnings, because there are and still a lot of earnings to come, but also to another product that's been just like I've joked many times in the show, we could do a whole show. In fact, we almost just did on our long and short of futures options episode earlier this morning, which will come out next week with our friends over there at CME, where we did a deep dive into all things crude. And we could certainly do a lot of that here again. But talking volatility, crude is where a lot of the action has been. We talked recently about how both OVX and OIV both spiking to near-term highs there, over 70 recently, and still extremely elevated as we come into today. About OVX and OIV both hovering around a 62, 63 level, so still markedly above that mid or so 40 handle, where both of them were vacillating for the better part of the past few months until all this oil movement started. Of course, a lot of the recent pop we saw in crude coming on the heels of that rumors of that Saudi-Russian conglomeration deal, whatever you want to call it there, on perhaps curtailing some production. Of course, those rumors have kind of been poo-pooed later on, but we saw that contributing to a lot of the rally we saw near term in WTI and other products. And some of that also perhaps contributing to an interesting change-ups we've been seeing out there in the skew for a WTI perspective in particular. We've been following this one for a long time. We talked about it last year, how when it got to around that 70 or 60 or so handles, where we really saw the first time that people were piling in to the upside, buying calls, buying futures, really specking that the worm was about to turn. We all know how that story played out. Now people expecting when it broke through the 30 handle that was going to happen, and it didn't really materialize at first, but now in the last week and a half, it seems to finally be starting to materialize. People are actually buying themselves some calls out there in the crude land. Of course, it's kind of mitigated to the nearer term months, as you might expect. Those futures still pretty frothy in the near term there, and of course a lot of vacillation in the near term. You go farther out, the calls are still a little bit richer than they used to be. You can't go out there and get those calls for a song the way you used to a few months ago, but still they're nowhere near as big as the near term. So the worm is starting to turn out there in WTI. A lot of people asking, hey, I think we even have a listener question about this. I'll just cheat and read it now. We have a question here from Black T. Signs of a turnaround yet in WTI skew? Are the bulls back? And I think the answer to that is somewhat, especially near term. People are expecting we're going to have a little bit of froth there popping back to the near term before it gives up. Longer term, we're not seeing people are still buying puts out there as well. The premium net going out to like D's and beyond is still on the put wing. So that shows you probably where the net structural concern still is. But in the near term, people are showing themselves willing to buy a call or two here or there, which is a bit of a change from recent history out here in this product. Mark, I know you watch USO a lot. Anything catching your eye out there in USO land, or even in the big crude oil options from a vol perspective?
Yeah, I mean, vol got pretty crazy last week, but is still trading in the 60s. So in OIV, which is the VIX of WTI, and OVX, which is the VIX of USO, they're both trading well into the 60s. So, things still don't smell that fresh. Let's just put it that way for some of these names. I think there's still some real fear in that oil could have another leg lower, or potentially even move around the other way.
Russell, anything catching your eye out there from a crude vol perspective this week?
Yeah, well, last week when we were talking about this, the skew was kind of leaning toward the call side on USO, at least going out for the next couple of expirations. And it just eyeballing it on my quote screen, it looks like it is kind of shifted to more of a smile from an upside skew. So instead of just the risk being that we were going to get some sort of pop in oil, it looks like the risk is that we're going to get a big move, but possibly a big move without anybody taking direction into account. Just seems to be a week over week change.
Yeah, it's interesting to watch the vacillation of those products, and clearly the puts are bid too. I didn't mean to imply that they weren't in WTI. There's definitely a smile shape, but we saw more strength on the call wing there than we have in recent months, which is kind of what everyone's been focusing on of late. All right, and that's going to do it for the old volatility review for this week, and now we're going to keep on rolling right on into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to my favorite portion of the show. Don't tell Russell or Mark, because this is the portion of the show where you guys get to join us here on the old program with your questions, your comments, your deep volatility insight, not just for us, but for your fellow VolViews listeners. You guys know the drill. The man at the top told you how to get at us, so let's just dive right into it, starting with a question from Andrew T. He writes, hey, Vega is pretty straightforward, but isn't gamma really a second-order Greek, since it measures the rate of change of another Greek? I don't know what it is about second-order Greeks, Russell, but our listeners have those second-order Greeks on the brain of late, and I think we can count on one hand, maybe no hands, the number of questions we received about them over the entire 9-year history of the Options Insider Radio Network, until about a few months ago, and all of a sudden they started coming in en masse. I don't know what it was that triggered the wave, but we've done a few shows on them since then. Of course, if you're intrigued by second-order Greeks, check out the whole show that Dan and I did there at Options Bootcamp recently about this topic. We also touched on it on Options Bootcamp here as well. And in a nutshell, yeah, you're right. Gamma is one of the traditional Greeks that we all quote, delta, gamma, theta, vega. Sometimes people occasionally throw rho into that mix, but not too often. But gamma is the only one of that traditional four that actually measures a rate of change of another one of the Greeks, which is why it's often difficult for new options traders to wrap their heads around gamma to begin with. It's probably the one we get the most questions about, and I'm sure you guys do over there at the Institute as well, Russell. And that's because it is, in fact, a second-order Greek. It's not really called that. It's not referred to that ever. It's kind of just always been considered a primary Greek. It's kind of funny how these distinctions just evolve over time. But you're right. It very much is, because it's measuring the rate of change, just like a lot of these other quote-unquote second-order Greeks are measuring the rate of changes of different other Greeks and other things like that. And if you want to get a deep dive into those, again, check out our Options Bootcamp episode. Russell, if you have any 2 cents on gamma being a second-order Greek, or indeed second-order Greeks themselves, have at it, sir. The floor is yours.
Well, yeah, I guess it is a second-order Greek when you think about it, but it still is just as important as the other three. It's not the redheaded stepchild of Greeks. But
you're saying it's not rho? Is that what you're saying?
Oh, rho's been kicked to the curb.
Rho is definitely the redheaded stepchild of all Greeks.
Oh, well, when we stopped teaching rho, I felt like that was a bottom for interest rates, but that was a couple of years ago, and we still haven't seen a rise in rates. But gamma, the way I like to talk about gamma is, first off, most traders don't need to worry about gamma. And then if you're one of these traders that everybody knows that's what you're into, and all they ever do is bug you about it, one of my favorite responses to a question about what I think about the markets is, I always say that I'm very concerned about my downside gamma, which basically means I'm just worried about a big sell-off in the market. It's just gamma. I like to think more of gamma just only really needs to come into consideration if you're thinking about a big move in one direction or another. And maybe we're hearing more about gamma than we have in the past, because we've been getting big moves in one direction and the other. I think I actually heard somebody or read where somebody said that we had 5 days in a row where the market was up 1% and down 1% in the same day. That's those kind of days when you're paying more attention to gamma.
Yeah, that'll make you learn the hard way about gamma if you're not paying attention to it already. I like that. That's how you blow people off. So if Russell tells you he's worried about his downside gamma, he's just blowing you off, listeners. So don't take any umbrage at that. We got time for one more here. This comes from TBig. He writes, you guys always talk about VIX futures term structure and contango impacting products like VXX. Just talking about VXX earlier in the show, as a matter of fact. He goes on to write, but doesn't the same apply to USO and the contango in the crude futures? What about backwardation in both products? How does that impact the ETFs? He's got a bit of a point here, Russell. We always lament a lot of the volatility ETPs, and for this characteristic. Probably because that's the name of the show, Volatility Views. We focus mostly on those in the show. We don't get into the crude futures term structure that often, but it is relevant. We talk about WTI and products and the options on them quite a bit on this program, so it makes sense we could talk about the futures term structure that they actually derive from. And you're right, there is typically that contango structure out there as well. They're kind of a bit in flux, like the volatility structures and products are right now as well, where you're getting some froth to the narrower portion of the curve, and that's kind of complicating that scenario a little bit. But yes, in all other things being equal, a product like USO should be negatively impacted by that longer-term contango, where they're essentially buying rich longer-term vol, selling cheap narrow-term vol, doing that over time. It's not exactly the best thing in your back pocket, which is why longer term holds, sometimes that can be questionable for things like USO. People sometimes like to go the other way, go to the more direct producers or things like that, or even like the futures themselves, because at least you kind of know what you're getting there. If you're coming in, you're buying the D's 2016 future, it's somewhere in the 50 handle. You know exactly what that's pricing in. There's no mystery about it, where it's kind of baked into the USO, but you don't really see it. And so that could sometimes be confusing for a lot of retail. Mr. Russell, what's your take on not just VXX contango and how that impacts that, but also products like USO and how they're perhaps impacted by the term structure out there?
The USO fund, it does have some exposure to contango, but I'm going to get this about half right here. But my understanding is USO gives you some exposure to some non-futures related energy, and so contango is not as big a deal with USO as it is with VXX. VXX and all those other ETNs, they are purely based on the front 2-month futures, and that rebalancing changes every single day. And this is not true this year, but it's been true in the past. Whenever that front month is at a discount to the second month, you have somewhat of a negative roll yield. My understanding is USO, it's not as dramatic, but it is something to be aware of.
Yeah, there's always that wild card with USO. You're right, because VXX is pure the VIX futures, whereas USO primarily trying to replicate WTI. But you're right, there is that little bit of fudge factor where they say sometimes they also invest in quote other oil-related futures contracts and may invest in other products like swaps and things. So there's that little, I don't know what percentage that breaks down to, but there's a little bit of fudge factor, you're right, which makes it not as outright terrifying as a product like VXX to buy and hold. We've talked many times about just go buy some VXX puts, long-term puts, and put them in your IRA. It's about as safe a bet as you can get in the marketplace these days, but maybe not withstanding right now with a little bit of backwardation going on. But USO, you're right, a little bit insulated from that, but still at the end of the day, they are trying to replicate that WTI future, and that has all the inherent issues you might assume from a product like that. Good questions, everybody. I like when they drag us out of our comfort zone sometimes here on the show, Russell. That's kind of what our listeners are wanting to do. All right, it's going to do it for the Volatility voicemail. Now we're going to keep on rolling into the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the Crystal Ball. This is the portion of the show where we prognosticate recklessly, some may say wildly, about the future of volatility. We started doing our guesstimates last week, and then Jared kind of got us off the rails onto prognosticating more about the Fed than actually on VIX itself. So we kind of had a bunch of over-unders on the Fed for last week as opposed to raw predictions about vol itself. I think most people would have put it in on it staying elevated to slightly down, probably right around where we are right now. I don't think anyone was leaning towards the spiking up to the 30 handle again. I won't put words in their mouth, but I'm guessing no. That said, this week we're hovering right around the 20 half level, so VIX cash actually getting a little bit of love here as the show progressed rather than selling off through the 20 handle. So Mark, we'll start with you. Where do you feel the vol gods will be landing this time next week?
I think we're going to stay here or maybe creep a little bit higher. Obviously, if we come in on Monday and we take a big leg up, VIX could really get a punch in the stomach, but the market is not pricing itself like that is about to happen. Even with the SPOOs rallying in the last couple of minutes, the VIX futures have rallied with it. So that's always an odd thing. We could obviously be setting up for the perennial vol dump at the end of the day, but everything is holding up relatively firm. So it's certainly in the immediate front month options. Vol's firm, VIX is firm. So I think that we'll be between 20 and 22 this time by, let's say Thursday. I don't know, coming out of non-farms, whether we will.
Mr. Russell, you concur, or are you going to take the point counterpoint there?
I'm extremely concerned about this employment number next week. I feel like I'm not saying that the Japanese knew anything, but I just feel like with VIX maintaining, relatively high levels, like Mark Sebastian said earlier on the program, with everything that's going on, with all the strength in the equity market, the front month future is barely, but stubbornly staying above the second month future, and VIX just wants to have a curvy number at the very front with the 20 handle, and you've just got to look at the numbers and you've got to wonder why. And, maybe the smart money thinks that we're getting ready to see another leg down in the equity market, and that's what's keeping VIX up here.
Yeah, obviously that employment number kind of being the wild card next week. It comes right before we do the show next week, so all of our predictions could kind of be out the window by then. But I'm definitely kind of leaning in the same camp. I don't see how we get much farther south here from a broad VIX cash perspective. Certainly by next week, I don't see a massive sell-off. I certainly see us in this range or perhaps a little bit higher. Again, kind of the gloves come off when the non-farm number comes out. Maybe that could change. The narrative could certainly shift, but going through that number, I certainly expect us to be around here or a little bit higher this time next week. All right, and that's going to do it for this episode of Volatility Views. But before we go, let me check back in with my cohorts, my partners in crime, see what they have cooking. Starting with you, Mr. Greasy Meatball, what's cooking in the land of the pit and indeed Carmen Line?
Things are good. Carmen Line continues to do well. Option Pit, we just had a super successful adjusting positions and managing risk trade that we session that we did last weekend. Our next Saturday class that we're going to do is actually a 4-day beginner boot camp. So keep your eyes out for that. We're going to introduce a boot camp for, maybe you're interested in volatility, but maybe you don't know that much about options. Well, this beginner boot camp is going to be for you.
There you go, listeners. Check it out, optionpit.com to learn more. And Mr. Rhodes was cooking in the land of the Options Institute and indeed SIBO.
Well, our classes are going to start kicking off for 2016 in the next couple of weeks. We're actually resurrecting my favorite program in March, which is
Russell's
College
Weekly
Day
Rundown
for college students.
Not Russell's Weekly Rundown.
Oh,
the class.
Fun! I can't wait to come out and teach my favorite section of that course. Life isn't like college with Mark Sebastian.
No, you don't get to do that one. You're invested in college students. No, College Day is just one day here at the exchange, doing some stuff on the floor, doing some trading simulations, and we schedule it during the height of spring break. Why go to Florida and take your clothes off when you can come to the CBOE and learn about the option markets?
There you go. You're selling me, sir. I'm sure you're selling everybody else. Don't take your clothes off. Come to the CBOE. New tagline for CBO marketing coming forthwith. But of course, you guys are also working on the big risk management show coming up in the end of February. Yeah, you guys are also working on the big risk management show coming up at the end of February. Surf on over to CBOE RMC to learn more about that. I'll be down there. Mark may be down there. I know Russell will be down there. So we may be doing some fun Vol View stuff from that show. Check it out. And of course, while you're there, surf on over to livevolpro.com. Kick the tires over there. See where we get all the fun data we talk about on the show every week. And on behalf of Mr. Rhodes from his corner office and the Greasy Meatball from wherever he's hanging his hat this day, and of course myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, and of course, sending in such great questions. Keep them coming. And we'll see you next time right here on Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.